90% of new traders lose money. But the real anomaly is who makes up that failure rate. We are talking about doctors, engineers, and MBAs, people who have spent their entire lives being the smartest person in the room. The trap usually snaps shut on their very first trade. A beginner clicks buy, the price ticks up, and they lock in a quick profit. Instantly, they assume their instincts are naturally aligned with the market, mistaking random luck for talent. That initial profit is a dangerous moment. It rewards undisciplined behavior, disguising a lack of structure as skill and breeding a reckless overconfidence. The reality is that the market is indifferent to your academic pedigree, your high IQ, or how badly you want to win. It does not recognize your previous successes or your emotional desires. If raw intelligence and top-tier education cannot prevent you from blowing up an account, the trait required to survive out here must be something counterintuitive. Most beginners try to survive by gathering as much external information as possible. They scour news headlines, chase rumors, and copy predictions, hoping to find a logic that will tell them what happens next. The market routinely punishes those who trade based on someone else's thinking. Every time you act on external commentary, you abandon your own plan, leaving you exposed when a trade goes wrong. The only metric that holds weight is raw, immediate price action. The tape doesn't care about the news, it only shows what is happening. Success in this business relies less on predicting the future and more on reacting to the present. It is an exercise in mechanical execution based only on what is happening right now. The reason so many smart people fail is that the human brain is miswired for this environment. Your childhood conditioning actively sabotages you here. In school, you were rewarded for having the right answer and punished for making mistakes. The highest achievers are conditioned to believe they must be right every time to succeed. Combine that with how society treats wealth. We are taught that losing money is a personal failure, a mistake that must be avoided. This chart shows how disconnected that conditioning is from the mathematical reality of trading. A person can be wrong half of the time and still be profitable if their positive yields outpace their small losses. But when the need to be right takes over, a trader refuses to accept a minor loss. They hold on to the position, rationalizing the dip and hoping the market will reverse to save their ego. That hesitation transforms a manageable, routine loss into a catastrophic, account-destroying mistake. The irony is that your natural desire to avoid a small failure creates the conditions for a terminal one. Your subconscious mind forces you to trade what you think is happening instead of what you actually see. You might look at a flat chart, yet your brain starts inventing a story. It convinces you a massive breakout is coming before any actual price movement validates it. Look at this sequence and try to say the color of the text, not the word itself. Your brain immediately jumps to a false conclusion that contradicts the raw visual data right in front of you. That same mental trickery destroys accounts. Fear and greed disguise themselves as logic, convincing you to act on instinct. The only defense is a system. You need a set of rules dictating your entry, your size, and your exact exits to remove emotion from the process. Without those rules to bypass your instincts, you aren't analyzing markets. You are a gambler with good posture. Professionals operate on a paradox. The best loser wins. They view a stop loss as a required business expense, not an emotional defeat. A restaurant owner pays an electricity bill because the enterprise cannot stay operational without it. Taking a trading loss works the same way. You have to accept uncertainty. By thinking in probabilities, you treat the market like a weather forecast, acting on a high percentage chance of rain without cursing the sky if it stays sunny. Your longevity depends on how cleanly you can manage being wrong, regardless of how much you make when you are right. This leads to the most ignored rule of survival. Cut your losses short and let your profits run. Fear drives amateurs to secure tiny profits the second they see green, while hope keeps them locked into losing trades until their capital disappears. History's legendary traders understood that the market rewards discipline and punishes arrogance. The psychological stamina to act with precision provides a more reliable edge than a high IQ. The market reflects your habits back at you. If you refine your execution, the results change with it. Refining your discipline is the only way to stay in the game.